Good evening, everybody. Welcome to our webinar number 30. I almost forgot which webinar we are at today. Wow, it's already webinar 30, and I have been doing it every 2 weeks without fail for you guys over the past year. So it has been more than a year now. And I'm actually thinking of trying to ramp it up. Hopefully, I'll have enough content for you guys to do this every single week for you guys in the not too distant future. Just bear with me a little while I try and sort out the scheduling and the content creation period so that I can bring you guys more and more content regarding portfolio management, regarding how to start planning your own investment. Of course, surrounding the idea of using ETF and other simple techniques to create a well-rounded portfolio for you guys. Today, we're going to talk something that I have been researching over the past few weeks. If you have joined me for the first time, welcome to our Learn with Stanley webinar. And my name is Stanley. And let me know where are you dialing in from, and what are some of the key things that you want to share and talk to me about today. Let me know in the chat below so that I'll make sure that I'll touch on that topic. But today we're gonna spend a little bit time diving deeper into some ETF, and I'd like to introduce guys to some ETF that is maybe not so mainstream, that you need to dig a little deeper to find them, and some interesting ways that you can use them in your portfolio. Okay, let me just share up the content. All right, here we go. The top 5 unique ETF for this week. Of course, as usual, just a quick disclaimer. I do work with IFA's global market as a wealth advisor, but do note that all the material here is prepared by myself and in no way represents the view of IFAS. And of course, what I do here is really more for educational purposes and educational purposes, and hopefully to bring you guys some information that you wouldn't otherwise get to know in the general public. But do remember to do your own research before you come to any investment conclusion. All right. And if you're joining me first time on my webinar, welcome so much. And I try to do this every 2 weeks. But like I said, I might try and ramp it up to a weekly webinar episode. And hopefully, we'll discuss more things that I like to touch on, be it stocks, ETF, some of the funds analysis. Also, just going back to basics like understanding investment theory and how to implement that. Well, I always believe that whatever theory that we learn is always important to how to put that in practice. And that's what I hope to illustrate in many of my webinars. And of course, as I mentioned just now, I'm part of IFA's global markets. I'm actually attached to the Johor team in Malaysia. And we are a wealth platform that allows you to get access to all the major major asset classes that you need to create a great portfolio for yourself. So do check us out as well. This is a sample ETF portfolio that I do for all my members, and also to showcase to my clients as well how they can go about building something like this. This is something that I track and I share with my clients on a regular basis if they want to know, and also through our internal discussion broadcast list. Okay, and that's basically what I try to do to help client review their current financial situation and finding the most efficient solution for them, or create a investment plan for them to help them reach their financial goal. Be it, some of them are saving up for their kids' education, or saving up for retirement, or saving up so that they can reach a point to be fire, to retire early. And all that, regardless it is, I'll try to create a portfolio that will suit based on their current situation and their financial goals. And I use that, not just with our iFast platform, also through other financial planning software similar like this as well, so that we can illustrate it in a much clearer view for clients that work with me. Okay. And of course, all this is still based on my key investing philosophy that I try to have discussion with everyone, which is I do believe that when it comes to investing, especially investing in the stock market, be it through funds or through the stock market, we have to have a long-term view. And I tend to focus on key growth market in the universe of stocks, but focusing on very, very long-term macro trends. And I like to always think in terms of risk management rather than chasing after stocks or ETF or be it a different sector that is in vogue in the moment, right? But rather think about how do you create a portfolio that can still give you a return that you want at the lowest possible risk that you can take. That's what I try to focus on, and through that, it means that to be more disciplined in your investment program, and also try to be contrarian, meaning that we don't try to chase the market, we don't try to be spooked by the market, and building what I call an everlasting portfolio, something that had actually served me pretty well over the past 19 years, where the same strategy that I employed 10 years ago is still the strategy that I'm using now, regardless of what my capital size might be over time. And and I've been tracking my own performance of my strategy in my portfolio for a long time now. And it has served me pretty well. And that's what gave me confidence that I can share such a strategy and such mindset and philosophy of investing with some of my clients and also some of my members as well. Okay, so if this is something that you want to chat with me on a personal one-to-one basis, you can always help me fill up this Google form, and it's a wait list for a free consultation with me, and I'll definitely reach out to you and give you my full attention on a one-on-one basis, right? So let me know, and if you want to check me out as well, you can go to learnwithstanley.com to see where you can reach out to me as well. Okay, but back to the main topic for today, which is ETF. And we're gonna spend a little bit time to dive a little bit deeper into different groups of ETF. When I say top 5 unique ETF, in a way, I'm actually going to share more than 5 ETF today with you guys. But I have selected some of the key 5 best group of ETF that I want to explore with you guys. So this will be ETF that is outside of the mainstream of ETF. And of course, when I talk about the mainstream of ETF, I'm talking about the main passive ETF that is tracking major stock market indices. And the most famous one, of course, Buffett has always talked about using the Vanguard S&P 500 ETF to track the S&P 500 index. And that is a legit and very great way to get started in ETF. But the ETF universe is so much bigger than that. And today we're going to explore a little bit deeper. Of course, before we even get started, let me track back to the beginning on if this is the first time you're actually hearing about ETF. So what exactly is an ETF? An exchange traded fund. So like the name suggests, it's actually a fund. So it's very similar to your unit trust, your mutual funds that you might be familiar with. They are a collection of investment of different strategy, but the most, I guess, common of them is buying equities, right? Right. So you will have a fund manager that will buy a group of equities in the most plain vanilla sense, right? The most common type of ETF, similar to a unit trust. And then that is packaged as a fund. But that fund, unlike a unit trust, is not sold through an intermediary. So it's not sold through a distributor like ourselves in iFast or through the banks. It is actually all already traded on the stock exchange. So we have ETF on Bursa as well, although not very popular, right? There is ETF listed in Singapore Stock Exchange, SGX. There is a lot of ETFs traded on Hong Kong Stock Exchange as well. But Hong Kong will call it differently. They call it Exchange Traded Product, ETP, but basically the same thing. And of course, the main ETF market is still in the US, where I would say close to 90% of all the ETF in the world are now trading on the US stock exchange. Okay, but apart from the most familiar one that we know of, the S&P 500 ETF or your Nasdaq ETF, there are so many type of ETF out there. And if you look into it, you might get a little bit dizzy because ETF is still at the end of the day a fund, and a fund can invest in almost anything out there. So there are a lot of bonds ETF out there, and within the equity space, there are so many strategy layer upon layer. We have what we call the passive ETF, where the fund manager is just focusing on tracking a particular index, but there are also active ETF where the fund manager acts in their own accord based on whatever their investment mandate is, right? So it's a lot of flavor. Think of it as a cuisine, as a supermarket. So there's so many different type of products out there, all different. These are just some of the main one that you might come across: your inverse ETF, your leverage ETF, your large cap, small cap, value, growth. We'll look into some of the more interesting ones that I think warrant your attention a little bit more today. Right? And the ETF market is actually very large. It might seem small, especially here in Malaysia, where it's not very popular. But the ETF market is almost close to half of the entire mutual fund size. So all the global ETF in the world, compared to all the unit trusts in the world, is about half the size of all the unit trusts in the world. And they are still growing much faster rate compared to the unit trust market. And let's dive into the top 5 ETF that I want to share with you guys today. What I'll do is I'll just talk a little bit about the group of ETF that I highlight to you guys, and then I'll maybe share and highlight some of the most common ones and some of the more interesting ones within that particular group. And we'll go through that for all 5 groups of ETF. So before we get started, if you have any question up to now on ETF that you're not familiar with, or you're still some areas that you're not very sure of, I encourage you to open up the chat and then let me know some of your questions, and then I will run through it with you guys. Alex, I have a question from you. How can I read the slide more clearly? Are you having trouble with the slide? Let me see if I can. Is everybody having issue with the slide as well? Let me see if I can change the size. I'll just change up the size a little bit. Give me a minute. Hopefully it's a little bit better. Okay, how's that better? Hopefully that is better for you guys. And let's get started. Okay, the commodity space. Commodity space, when it comes to commodity, we are talking about everything that is a raw material to Bitcoin and other asset class that doesn't have an underlying business to it. So some of the biggest one, of course, in today's commodity market, you have your oil ETF, you have your gold ETF, you have your Bitcoin ETF. But so far, I would say that to an investor standpoint, maybe the 2 most important ones that we might want to look at is, of course, the newly launched Bitcoin ETF. Just last year, there's a few launch, and our very uh, uh, very reputable gold ETF in the market. And I'll introduce one of each. These are the biggest of the commodity classes so far. And the gold ETF is GLD, right? So if you search on the ticker, be it Google Finance or on our iFast platform, when you search GLD, you'll find the Gold Spider Gold ETF. And this is a very, very interesting ETF because the entire ETF, when you invest in it, they will use the money to buy physical gold. And so all the funds are actually backed by physical gold. Um, and they currently manage close to $90 billion of in this gold funds. So, oops, in this gold fund. So it's a very, very, very big ETF. And it's also listed in multiple markets. They're actually listed in I think six market, but um, those that are more relevant to us is they are listed in US, they're listed in Singapore, and they're also listed in Hong Kong. So you can buy through any of these three markets. Um, some of the interesting aspect is, of course, gold. We can't see the fundamentals, right? We can't really value how gold is undervalued or overvalued, but the long-term performance has been pretty good in terms of US dollars. It is still growing at about 7.6% over the past 10 years. So every single year return over the past 10 years for gold ETF is about 7.6%. And over the past 5 years, of course, gold has been shooting up quite rapidly, especially when the fear of inflation came after COVID. And in the 5 years alone, they have grown close to 11% a year. And this gold ETF has a very, very reasonable expense ratio of just 0.4%. So what's the expense ratio? Expense ratio is basically the fees that we have to pay back to the fund managers. So 0.4%, that's very, very reasonable. So for what $1,000 of investment, you will be paying just $4 per year to the fund managers. Uh, quite reasonable. And another one is the IAU, so the iShare Gold Trust ETF. All both very, very similar, but this one just a little bit smaller in size, about half the size of GLD. But this is only listed in the US. So you can see the return is almost identical, but IAU is actually have a much slightly better return because it has a slightly lower expense ratio. So apart from that, their return is close to identical, right? And on the other side, on our digital gold side, where it's launched last year, we have two of the biggest one today. One is IBIT, the iShare Bitcoin Trust, and also the FBTC, the Fidelity Wise Origin Bitcoin Fund. Both also have a very similar structure, even similar to the gold ETF. So whatever funds that we invest in, it will be used to buy Bitcoin. And the difference here is only how they uh, custodianize the Bitcoin. So for IBIT, the Bitcoin is actually hold on a custodian with Coinbase. Coinbase being one of the largest cryptocurrency exchange out there, also a listed company. And for Fidelity, they have their own digital asset custodian. So their Bitcoin is actually still hold in their own custodian. So the size between the two of them, the IBIT is about a $48 billion fund, while the Fidelity one is about a $16 billion fund, and also identical expense ratio. You notice that I didn't put any performance data right here. That's because this is very, very new and they only launched last year. So whatever performance is quite irrelevant. And it's just a fun for you to invest in Bitcoin in a more straightforward manner. say, because for myself, I have tried to, just experiment in Bitcoin and other cryptocurrency in the past, when it was still coming up. And it's a very, very hassle process, at least in the past, to invest in Bitcoin. And I have to buy from very, very unknown exchanges or just platform, peer-to-peer platform of buying Bitcoin from some other people, or you have to go through. I remember once I have to invest some fund, some money with, say, a cloud mining company, more or less like a timeshare. So I'll explain the scenario, right? Uh, when I invest and try to dabble myself in Bitcoin, it is more of an experimental mindset. So these are money that I really don't mind losing everything, and I'm only using a very, very small amount of capital just to try out this something new. Just like to experiment. So I wasn't thinking too much of whether I'm going to lose this money, because these are money that I'm prepared to lose. And so that's why I was able to experiment with a few platforms out there, some cloud mining company. At the end, I do collect some Bitcoin, but it always have to go to my own wallet. Right. In the past, there isn't really exchange wallet where like now it's quite easy to hold it on your app. So I have to have a physical cold storage wallet where it's basically just a dongle, and they give you an address and you have to send to it. And only with that dongle connect to your computer. Maybe more like our bank token, right? Only when the two matches, then you're able to see your cryptocurrency. I have an experience where the dongle spoiled on me. I also have an experience where the dongle, not the dongle, my computer spoiled on me because it's linked to one computer only. And so when my computer died, I have to transfer it to another place. And it's a very long process. It's not impossible to get back. It's possible to get back, but it's a very, very long process to get back the money if you have it in cold storage. So there's a long-winded a way of saying that, I think having all this Bitcoin ETF, or, in maybe in the future, or other cryptocurrency ETF out there, if I had the choice, a few years ago, I would say that this is a much friction let a much less friction option for me to invest in cryptocurrency or to dabble and try with it. So that's just some of my experience that I wanted to share with you guys on why I am also excited with such ETF coming online more and more. Okay, so that's for the commodity ETF. Of course, you can also search for other commodity ETF. I encourage you to do that. I'll share with you a few resources later on, a few websites that I use on finding more ETF and comparing them. Where are some of the website that I use to compare them? I'll share with you guys later. But the next group of ETF I wanted to share with you guys is actually what we call a Master Limited Partnership ETF, MLP for short. I would say this is the type of ETF that is only available in the US, because the US being the financial hub of the world, they have so many different types of financial engineering that is almost unheard of in our part of the world. That's also what makes them a little bit more interesting, and to find a very unique type of investment opportunity that might not be available in our region. So MLP, basically, you can see them as a trust company. So a REIT might be a form of master limited partnership, right? But they basically a partnership or a trust that holds certain asset that continue to generate revenue for the partners or the investors. And it could be very, very often. It could be things like toll roads, pipelines, anything that is like a toll road type of businesses, ports, it can be parked under an MLP. And for the past few years, I would say the most attractive MLP out there um, has been the oil pipeline MLPs that has been performing very, very well as oil prices has recovered. Uh, right now, if you read about such MLPs and such oil pipeline MLPs, if you want to dig a little bit deeper, you would have a little bit more diverse view right now, where many strong investors have diverse view about how some of these prospects might be going forward, mainly because of their strong run in the last few years. But I would say that these are still very, very interesting ETF to look at, especially if you're someone that prefer a little bit more stable kind of cash flow kind of business that you like. MLPs typically tends to buy out asset that provides a rental type of return, like your oil pipeline. Okay, I'll just touch on a few of the bigger ones. Both are oil pipelines and energy related MLPs. One is the AMLP, the Aulerian MLP ETF. I would say this is the biggest one that I can find around in this sector. It has a size of about 10 billion. So pretty decent size. But you can see that their return, if you go check out the chart of it, you can see that it's pretty volatile because it, of course, is linked to commodity prices, to oil and gas. The last 10 years compounding return for this ETF is only about 2.5% a year. But if you look at the past 5 years one, it has been compounding close to a 12% return every single year. And it shows you that even though some of these ETF, some of these NLP ETF, they have toll road like business model, the pricing of their revenue can fluctuate a lot based on their underlying uh, commodity business they're in, right? So do bear that in mind of the risk of such ETF, but still nonetheless very, very interesting. And but of course, you can imagine the work involved in managing both this partnership and also this ETF. You'll take a little bit more expenses. They are running out and finding deals, buying out these physical asset, to manage and then pass the return back to investors. So there's a significantly more work involved compared to say just a stock passive ETF. So the expense ratio is also reasonably much higher as well, about 0.85% per year for the AMLP ETF. But for its counterpart, this one EMLP, the First Trust North America Energy Infrastructure Fund, it has an expense ratio of 0.95, slightly more. But this one is focusing just, I would say it's a little bit more focused. And you can see that their long-term compounding return is quite different. 10 years compounding or 7.2%, 7.23%, but the past 5 years compounding return has been phenomenal, 19%. So the skill of the fund managers also would have a big impact on the return for such ETF. So very interesting for you guys to check it out as well. Okay. Along the way, if you have any question, do point out to me through the chat, or if you have any comment, or if you these are particular sector that you have studied that you want to share some of your findings with our fellow participant as well, I encourage you to have a chat on the chat box together. The next one, I just want to highlight to you guys, these are equity ETF, equity and bonds ETF, but there's also what we call a balance fund. So very, very similar to say our unit trust industry, where you can have your pure ETF, pure unit trust. You can have your pure bonds funds, but you can also have a balance fund where it's a mixture of it. It's a very, very similar case for ETF as well. So they have balance ETF as well. Some of the key ones, of course, is I would like to share with you is iShare Core Growth Allocation ETF. So this one is the 60/40 one, the AOR, but they do exist in all the different format, the 20/80, 40/60, 60/40, 80/20. So this is all out there. It's all separated out as a different ETF. And this one in particular is a size of about 2.2 billion. And you can see that their long-term compounding return also pretty decent at about 6%. 5-year compounding is about 6% per year. And the expense ratio will be quite low for this one because this, at the end of the day, is just a equities and bonds fund. The expense ratio is only at 0.15%. 0.15%. Very, very competitive. And if you look it up, some of their top holdings, it will be very, very similar to, say, your Vanguard S&P 500 ETF. On the equity side, they more or less buy very, very similar things. All they want to do is really track the performance of the market, and then the performance of the bond market as well, and then blend it together to give you a blended return. So you can see that compared to, say, your S&P 500 index, the return is much lower, maybe by 4%. But of course, also in line with their own investing strategy, which is a 60/40 type of investing strategy, or more balanced funds. This fund has a size of about 2.2 billion. And the next one, which I find it pretty interesting, is the NTSX, is Wisdom Tree. Wisdom Tree US Efficiency Core Fund. I would say that if you look through ETF, there are a few big houses that do ETF. You have your iShare, you have your Spider, which is State Street. You have your Vanguard. These are the big names, right? These are the big names that are doing ETF your out there. But there are also some smaller funds house out there that are doing pretty interesting things. And I think Wisdom Tree is one of them. A much smaller ETF house, but they do have quite an interesting selection of ETF as well. So if you just want to search in terms of the fund houses, I would say Wisdom Tree is one that is quite interesting to look at as well. For this one, it's also a balanced fund, but I would say this is more towards equity. So I don't quite remember the blend, but it's much more concentrated in equity. So that's why you can see the 5-year compounded return is much higher at 12.4% a year. The expense ratio is 0.2, still very reasonable. All right. And now, one of the ETF grouping that I would say I am most optimistic about, and something that I use quite often, especially when I talk to clients on discussing with them how to create their portfolio. I believe in using sector ETF or sector funds, where we choose the specific sector that we like for the long term. And some of the ones that I think is interesting for you guys to look at before we run into that, sorry. So you can see that how we separate out different sector for ETF. When I talk about, I think the key difference here is when we talk about, say, unit trust, many of them like to separate out the differences based on the geographical market. Right? A few years ago, we have the China funds, a lot of the dragon funds. Even way back, maybe 10 years ago, we have the brick funds, right? They like to focus on finding different geographical market. But I think ETF like to separate, I would say separate themselves more to the industry per se. So they have the technology ETF, the financial ETF. So I find this much more useful, at least from my viewpoint on how you want to invest. Because there are so many global companies out there. It's no longer that important which market that we invest in, but rather the sector that they are in, which sector of the industry that we feel we are more optimistic about. Of course, you can see that from the past 10 years bull run of the technology sector, the technology ETF is the largest of them all. Even their size is, I think, almost just their size is bigger than all the rest of them, if you add them up. And that's the power of the technology sector, and why I think a key reason also one of the reason why the technology sector has been seeing very high valuation, because so much money is pouring into it, and a lot of it is actually in technology ETF or technology funds, that might have to invest in them regardless of how highly valued they might be. So this could be one of the reasons. But of course, apart from that, you have your financials, healthcare, or you just like energy, real estate, material, your consumer, all the way down to telecommunication or consumer staples or utility. I would say some of the telecom and utility is a little bit interchangeable, but there you have it. And two of the key ones that I want to highlight to you guys, of course, the largest one is the Vanguard IT ETF, VGT. This is close to 100 billion fund. And you can see as a technology fund, the last 10 years compounded return is close to 20% a year on this fund alone. And this is a passive fund, right? There's no real fund manager risk here. A lot of active funds out there. I think one of the key risks we have to be wary about is the fund manager risk. So if it's an active fund, we rely on the ability of the fund manager to make good decision to outperform the market. But a passive fund, like many of the Vanguard funds, they just follow whatever the index is made up of, and they just invest based on the weightage in the index. So it doesn't matter whether they change fund manager. It has no implication on the future of the fund, which is also why I tend to prefer, for most people, I would say investing to passive funds could be a much safer and more viable and sustainable way to invest. And you can definitely see it in this ETF. Even the 5-year compounded return is about 21.5% a year. So this is a per year return. And at a very, very low cost of just 0.1% expense ratio. And you'll see that with a lot of the passive funds, their expense ratio would be at all this very low range, 0.1, 0.2, maybe up to 0.5. Next one is, I would say, a rather overlooked ETF, because it's a rather overlooked sector, which is the Industrial Select Sector Spider ETF, the XLI. Why is overlooked? Because they invest mostly in a lot of what we call Dow Jones kind of industry. Your 3M, your Caterpillar, your manufacturing, your old brands, your GE. So these are no longer the sexy kind of companies. But remember what Buffett says, boring is good. Boring is profitable. And it's certainly the case as well, because these are companies that in the media nobody talks about, and yet in the last 10 years is still compounded at 11% growth rate. And the last 5 years is compounded at 15% growth rate. You know, be it that the market has been doing very well over the past few years, but it's not too shabby for unloved, unspoken about industry. In the old school brick and mortar business, they're still doing pretty well as a group. Okay, so how many different types have we gone through? We've gone through three, I think, or four. I'm getting old today. Just checking up on some of your questions. I'll come back to them. But let's go on with it. The next one I want to talk a little bit about. So we talk about all the passive ETF. This one is actually a active ETF, a long short ETF. So what does it mean by long short? When it comes to investing, of course, when we say we long the market, meaning that we're investing, we're buying into the market. But when we say we are shorting the market, it means that we're selling the market. We're betting that the market will go down. We're betting that the stock will go down. Right. At one point, if you follow, say, Tesla stocks, Tesla stock is one of the most short stock in the history. And that made Elon Musk very, very angry. And he's trying to get the short sellers to get out of the stock. And that's basically how the market works. But there's people who are buying, but there's also a group of people that like to short the market. They like to what the mechanics of it is if I own say, let's go back to Tesla, okay? If I own Tesla today, my stock is just sitting there in the brokerage doing nothing. And some brokerage will allow security lending. So when I open the account, they will have me read their disclaimer, and one part will be that my security could be lended out for other people to short. And what happened is if I have these shares and somebody, another client, want to short the Tesla stock, he would say that he want to short the Tesla stock, and the mechanics is the brokerage will borrow my stocks to him or her, and then he can click sell even though he don't own the stock in his portfolio. And when he sell, the money will go to a collateral account. He can't touch the money yet, but it will go to a collateral account. It means that it is put back into cash, and it's just sitting there. And if the stock price really falls, he can say that he want to close the position. He can buy back. So he's now buying back the stock at a cheaper price. And whatever the difference, he can profit. And then how the brokerage profit is they are lending the security. They would typically have an interest rate that they lend the security at, be it 6 or 8% per year. So then the security will earn. Some brokerage would share it with me as the owner of Tesla. Some might not. So this is just a little bit nuances and the under workings of brokerage in the world. Just a little trivial. But of course, again, the long short equity strategy, there are a few out there. Compared to the passive long only ETF, of course, they're very, very small, but still pretty sizable. So one of the largest one is First Trust Long Short Equity ETF. And this has a fund size close to about $2 billion. You can see that the past 10 years compounded return is about 8%, past 5 years about 12, 13% a year. The expense ratio typically for this kind of strategy is much, much higher. The idea is they would argue or they will market themselves as a more safer option to a long only fund because they are both buying and they're also shorting ETF. So the idea for them is they market themselves as they are not so affected by market ups and downs. But of course, in reality, many of them also still follow the market's up and down cycles. Because typically a long short strategy, most of their funds would be in the long side. So they will still be predominantly buying things. And only a certain percentage of their fund is used for shorting stocks. Okay. And so far, I would say that at least because in the past 10 years market cycle, not many of them actually outperform, say, a long only strategy, just because the long only strategy has been doing pretty well. This is one of them. Another different type of long short is what we call managed futures. So one of the key ones is Simplify Managed Futures Strategy ETF. The ticker is CTA. This is a little bit different from a long short equity ETF like the one we have here. This one, you can see it as almost a hedge fund kind of strategy. And managed futures is basically they are not buying and selling equities, they are buying and selling futures. Futures is, you can see it as uh, a contract for commodities, right? When you buy and sell commodities, you'll buy futures on locking the price uh, and selling it at a fixed price. So if you are familiar with, say, options on equities, futures is basically the similarity to option, but for commodity prices. So they are not betting on any companies or equities per se. They're betting on different commodities out there, buying and selling the futures of the strategy. So I personally, I don't know much about this strategy, uh, and I've never practiced it myself. So what I read about some of this strategy is they allow uh, investor to reduce the volatility in their portfolio. So, for example, I'll give you an example how one might use such a managed futures ETF. Say you already have a portfolio that you build up over the years, and it's a big part of it, say 80% of it is in equities, and you have maybe 20% in the bond funds out there. And you feel you feel pretty okay with 80-20 bond funds. But the proposition of managed futures strategy and ETF is that they propose that if you add maybe 5 or 10% of your allocation from equity or from the bonds to managed futures, you could potentially reduce the volatility of your portfolio because they are just buying and selling futures, which is not as correlated with the stock market or the bond market. So it's another asset class. And because of the non-correlation, uh, they can help cushion the market cycle. So when the stock market is going up, maybe the managed futures is not doing so well. But when the stock market is not doing well, maybe the managed futures could be doing well during that time. Uh, these are all theories, right? Of course. And what happens is you get a portfolio that don't fluctuate too much, right? As much as, yeah, not don't fluctuate as much. So it doesn't go up as high, but it doesn't go down as much. And in a sense, you could have a what we call less volatile or safer portfolio, right? And typically, they are much smaller in size because of a niche strategy. And this particular one fund size is about 800, 900 million. But it's also quite a relatively new type of ETF out there. So they don't have too much data. The expense ratio is about 0.75. Okay, so these are some of the key interesting ETF that I wanted to share with you guys. And if you want to find out more about ETF, of course, from our own iFast platform, you can definitely check out a lot more information. This is a screenshot from there, say ETF that you can see the top holdings, how is the performance is, how much is the investment information like the fund size, management fees. We also include a calculator where you can actually calculate if I want to buy this today, how much could be my brokerage fee. So for you to work out how much it exactly costs you to buy into the fund. I'll just share with you guys a quick one on other website that could be useful for you guys. One of the other ones that I use could be Morningstar. I'm a paid subscriber myself. I paid for the subscription, but it's free for you to use as well. So just a paid subscriber, you get a little bit more information, but you can use it for free as well. And I like it because it has quite good detail on, say, this particular funds. It can show me what are some the breakdown on the different size of company that they're buying, the valuation, right? For equity fund, especially if you want to check out how this fund is being valued compared to its average or the index itself. They list it down here: price to earnings, price to books. You can see based on the average of other categories and the index and how this fund is doing and where you are exposed to. I like this very much, where it lets me know which industry I'm being I'm investing into, especially when I'm planning out a say a portfolio for myself or for my clients. This is something that I use to make sure that we don't over allocate into a particular sector, right? Especially now with technology sector being such a big chunk of the main market in a lot of the ETF. If we are buying a lot of ETF, end up all the ETF are invested in the technology sector. We are very, very exposed to the technology sector and how we want to rebalance that and have reduce the exposure a little bit. Yeah, this could be something for you to take a look at as well. Oops, let me see if I can move this. Something is blocking my view. Another one that I use is etfdb.com. So if you can see it on top here, etfdb.com. Excuse me. etfdb.com, one of the better ETF database out there. I would say that, I use it quite often to check out different ETF. They have a screener, they have a category that we can check out different particular types of ETF that I want to find out. And say just European ones. What are some of the key European ones out there? How well it has been doing, say over the past 5 years, this year, all that jazz. You can find it pretty well here. All right. And if you have not noticed, you realize that I'm pretty passionate about ETF, and I really think that they are a very, very useful tool for individual investors like ourselves um, to build a more than enough diversified portfolio for us. And the example that I gave today shows you the breadth of ETF on the all the different types that you could possibly gain exposure to, be it your equity, your bonds, real estate, particular currency, commodity, even hedge fund strategy, your MLP, where the infrastructure play. We can all use ETF to have access to all these different asset classes. And for most people, I would say it's more than enough to create a very, very strong portfolio that could do well in the long term. And this is basically a key part of my work, something that I really spend a lot of time in understanding and researching and coming up with solutions for my clients and building up a portfolio and a proposing portfolio that could give you the um, that could match the potential that you're looking for, but at a more efficient and more reduced risk uh, version of it. So these are just some example that a model portfolio that could potentially, or how I design it, where I want to invest in, where are the allocation. This is how I visualize it, and size it up, uh, you know, possibly for my clients. And of course, I do that in actual form with my own ETF portfolio that I showcase for my members and my clients as well, just to eat my own cooking, I guess. But I would also like to highlight to you guys that nothing is perfect. Nothing is perfect. There's no one instrument in the world that is perfect. And there are issues with ETF. But the key is we just have to understand it and to see if we are able and willing to accept it and work within its constraint. So some of the issue with ETF, I would say that at this moment of time, they might not be great for like bonds or dividend funds, anything that give a dividend or distribution on an ongoing basis. Mainly because most of them are listed in the US, and US do have a withholding tax with us, 30%. So every dividend, every distribution, every distribution that the bonds fund will give back to us will be taxed at the 30% rate. So when you calculate that, it might not be that great for dividend investors. There are ways, other option to mitigate that, but it's a very long topic and maybe something that we'll touch on in a future episode. Few other things is many of them are passive funds. So if you're someone more aggressive looking to outperform the market, ETF typically don't outperform the market that much. Many of them don't outperform the market and can guarantee to underperform the market because they're just tracking the market and they take a little bit of fees on top of it. So they are guaranteed to underperform the market. But my view is if we invest in the right with a right mindset and the right time horizon, typically the market itself will do pretty well. And this has been the case for the past 100 years, I guess, if you talk about the US stock market, especially. But even for local markets, if your time frame is long enough, typically the market do grow over time. Next one is it has less promotion. Of course, there's no one really pushing ETF because there's not much money in ETF for advisor like ourselves. So less people are promoting it. But it also means that as an investor ourselves, if we want to venture into it ourselves, we have to take a little bit of ownership. That if we make a mistake, it's on us. And this is something that I think, uh, although many people might be okay verbally on it, but when things happen, uh, our internal struggle typically is we want to have someone to blame to make ourselves feel less worse, uh, myself included, right? And this is something that we have to take note because market always come in a cycle. Markets never go up consistently. In my own experience over the past 6, 17, 18 years, I would say that every 2, 3 years I can see a dip in my portfolio. Not all the time, but typically. And we have to be steadfast enough to withstand that drop and stay consistent and still at least stay faithful to the process, right? Not to make it sound a little bit religious, but uh, we do need a little bit of faith when we're investing. And the last part on ETF is something I think about, and I think something that could happen one day, which is because of the rise of ETF, and many of them are passive ETF, meaning that they don't care about the valuation of the equity or whatever they're investing in. They're just following whatever is in the index. They will invest as what the index weightage is. So it might encourage mindless investing. And we have the growth of the ETF market. We have the encouragement of guru like Warren Buffett saying that you know the best way to invest is in to invest passively, and all this dogma. As we encourage more and more, the market typically would always push an idea to the limit, right? The market never really know how to regulate itself so much. It's always trying to push too much, and then everybody panics and lead to a crash. Be it Bitcoin, be it stocks, be it bonds, every asset class. And it's just human nature. So what I worry and what I think one day it could happen is that all these mindless investing into passive ETF could potentially lead to a bubble where the bubble just pop, and the market would see a very, very sharp correction. Um, of course, market cycle, like I said, market pop all the time. And this could happen in a small form, it could happen in a big form. To me, I feel that it's just how the market works, and we have to be comfortable with it. Okay. Another concept that I want to bring to you guys is when it comes to building wealth for the long term, the output is only one part of the equation, right? We often think of the output. Wow, how much my stock could make, how much return it could give me, then I'll be wealthy. How much this fund could give me, then I'll be wealthy. But we often forget the input side, and I would argue that is actually the more important part of building wealth for the long term, which is just the regular savings, month in, month out. That if we can put that money into the savings account, into the investment account, we would have a good result in the future. Case in point is if you're just saving, if you're saving, say, $2,000 a month, and you're not doing anything about it, you're just putting it in the bank, right? Not even a interest account, right? Just putting $2,000 every month. In 20 years, you'll have $500,000. But if you are able to put that investment into something that could give you, say, a 6% return every year, just a 6% return every year, that $500,000 of saving could potentially become 900,000 or $1 million in 20 years. And this could happen, even at a very, very small amount. Like you say, maybe $2,000 a month, that's so much. That's $24,000 a year. That's too much of a investment to even think about. What about just $5,000 a year kind of saving to start off with, right? And even just a $5,000 a year, if you are able to grow it 10, 15%, right, it could grow up to a few $100,000, right, in 10, 20 years. Because the key here is being consistent. If you're consistent with the input, the output is the bonus, right? If we cannot be consistent with the input, regardless of how great the output can be, you will not get the result that you want. And after investing for so many years and talking to so many people who is on this journey, I would say one of the one of the thing that I try to encourage everyone uh, is to really be reach a point where you're comfortable investing at an amount that is meaningful to you. This is what I mean. Very, very often, say when I have my say dinner night out with my friends or everything, if they know that I'm from the finance industry, they always ask, wow, what stock to buy? What stock to buy now? What can be a good stock to buy now? I don't really know how to answer that question because typically they are always asking for a quick uh, stock pick. And if you invest long enough, you know that at the moment stock pick is as easy as good as a guess. Um, it's pointless, right? But they're expecting something. And what happened is uh, even then they'll share stories of how they buy stocks or how they make gains on some stocks. And some stocks has grown 10% in the last week. Uh, that's great for them. But the point is, many of them, when they invest in in a stock tip that you just hear from a dinner, you're not going to put your life saving into that stock, right? More or less, you put something that what you call your play money, and it could be $1,000, $2,000, right? And you buy into it. If it drops, you blame your friend. If it go up, you're happy you earn some pocket money. But in the long run, it would not make any difference at all. Earning extra $100 once in a while is not going to make any difference to your net worth and your wealth in the future, in the long run. It's not going to help you in your journey to reach financial independence, to reach your retirement goals, or to your kids' education fund. Because those goals would require amount much, much bigger than that. And which is why a lot of us end up losing faith in the stock market because we are always only confident to put very, very small amount. And when we earn a little bit, we're very happy. But once we lose confidence in the system and we stop. And the key here is actually faster reaching that hurdle that you push yourself above that you become comfortable investing in much larger amount that will be meaningful to you. And to do that, I would say number one, you have to be gain the experience. And in my case, which is paying a lot of school fees to the stock market until you reach a point where you know how the market typically behave and you're going to be comfortable with it. Or number two, finding a way or system to help you create that momentum and finding ways to create a portfolio that will reduce the risk uh, to a more manageable level. And I think using ETF instead of going into individual stocks is a good way to get started at least. And it's one of the key things that I work uh, actively with my clients on how to create that system and to create that portfolio so that we can invest amount that is meaningful and do meaningful change to your wealth in the long term. Okay, so that's more or less what I hope to convey. And I mentioned all this before. So if this is something that you're interested in, to speak to me directly, definitely do reach out to me. And I also wanted to highlight to you guys why a lot of the ETF you can see that their expense ratio is very very low. And it might not seems like a lot, right? If you pay even if you pay like 2% a year, 3% a year, or on a, but that's every single percentage point, like say 2 percentage point. You can see that this is just a illustration that I did. If you invest 100,000 today, and just the 2% difference, if you spread it out, especially if you are investing for your retirement 20, 30 years later, that 2% every single year can compound to millions of dollars at the end. And this is something for us to understand the rule of compounding. The longer we do something, the more little bit of percentage point would balloon up to very, very meaningful sum. So I hope you guys enjoy the chat today, the discussion today. Of course, my name is Stanley and I'm attached to iFast Global Market down in Johor Bahru. If you are in Johor Bahru, remember you can always drop down to our office to check us out. But if you want to speak to me personally, I encourage you to just fill up this Google form and hope you can reach out to me uh, and we can have a chat one-on-one. I'd like to take some of the questions now before I go into our spin-off section, right? Let me see if we have any questions. Uh, Kim Siu, thank you. I think you are sharing some of the interesting ETF that you are looking at. Thank you very much, and I hope you guys can check it out as well. Kim Siu is asking, how do you value an ETF like a company? So I think just now I share a little bit on that. So you can use a website even for our own iFast platform or things like Morningstar. When you click on the fund, typically on the valuation side, they will share the current valuation of the fund. Okay. Tina is asking, does FSM1 deduct the fee at the same time? I find confusing to track the email for fees deducted. Uh, this is from Tina. Okay, so FSM1 is actually our sister company. I would encourage you guys to check with them if you have the support line or email, because I'm with the iFast part, and FSM1 is considered a sister company, so they might have different fee structures compared to us. Yep, thank you. And Kim Siu is also having other comments. Buy Hong Kong ETF for bonds, no tax. Yep. There are no withholding tax for Hong Kong or Singapore. You're right. And there are other options as well, definitely. Thank you. Thank you so much. Before you guys go, as always, I always touch on a little bit on a spin-off section where these are totally not related to our topic, but just something interesting that I have found over the week. And as you guys know, I am an avid podcast listener. Uh, and one of the great episodes that I listened to this last 2 weeks, I think, yeah, is this episode in Diary of the CEO by this person called Vince Gunn. And he's a communication coach. You can find it on YouTube. And sometimes, you scroll through his link on his ad on Instagram. But very, very interesting guy. An Aussie. And he just break it down for us on some of the interesting communication tips that could help us improve our communication skill. And I find that this is an area I really wanted to improve on as well. Uh, and some of the key things that he was talking about that at least uh, is something new that I learned is that he talked about the idea that our voice is actually our instrument. So how we speak can be seen as a way of how we play our instrument. It doesn't need to be always a monotone that we are used to. And many of us don't change it because we have an image of ourselves, but he's basically saying that that image is self-imposed. Uh, we can change our voice, we can change how we speak. It doesn't make us less us. That's pretty, I would say, powerful. I guess takeaway that I have from the interview. And also the next one is that we always talk about being generous, maybe doing charity and things like that. We always talk about being generous with either your money or your time, but he also touched on the fact that we can be generous with our energy, right? So even if we give the time of the day for someone, but we are always, our mind is not there, we are disinterested, it's as good as not being there, right? And the key that to be generous, we can also not just to give money, our time, we can also give our energy to someone to make them have a more memorable interaction, more memorable experience during that moment. And that's also being generous. And I think that's pretty powerful. Okay. So that's all I want to share with you guys today. I hope you guys enjoy it. And as always, I'd like to leave you guys with a simple quote, which is by da Vinci. Maybe I can't find the real source, but of course he said simplicity is the ultimate sophistication, and I think that that's definitely true when we come to investing or building a portfolio. As we learn more and more, we might want to experiment with very complex and interesting strategy. But I realized that after coming round the whole point, sometimes having more straightforward strategy and simplify the idea and the process works best. I'll leave it at that. Thank you so much once again. My name is Stanley. Till we meet again. Invest safely, guys.